Okay, I'd like to present you some of the panelists. So on my left side, that's Jos Brumagne. Jos Brumagne had a career in banking, for instance, at Dexia Netherlands, I think. He was also Chief Risk Officer at the Dexia Insurance Company, and now he's responsible for public and corporate business at Belfius Insurance, the new name of the Dexia Insurance Company.
The new name, eh?
The new name, yeah. Okay.
Formally known.
Yeah, okay. Mächler. Mächler, in the past, she was CEO of the Swiss Federal Office of Private Insurance. Until September of last year, she was the vice chair of the board of directors of FINMA, and FINMA, that's the Swiss Financial Market Supervisory Authority. And now she's teaching and publishing about regulation and international law. On my left side here, Antonio Cano is CEO at AG Insurance and a member of the management committee of AGEAS. This is Hugues Pirotte. He's a professor of finance and risk management at the Solvay Brussels Schools of Economics and Management of the ULB. But he's also co-founder of FinMetric, and FinMetric, that's a Swiss company specializing in cutting-edge advisory in financial risk management. And the last speaker is Jos Brumagne. Sorry, it's Henk Janssen, excuse me. He's CFO of Chief Financial Officer of Baloise Insurance, and that's the new name of Mercator Insurance. Mercator is a part of the new group. Hello. So, let's start the panel with to talk about risk management. For example, Hugues Pirotte, you say in risk management, the word management is completely misused. Why the word management is completely misused?
Well, it's not misused by everybody, but it tends to be sometimes misused in the sense that a lot of the regulation is about risk measurement, about monitoring, but there's not much room about what do we do with the numbers and the reports we produce. And institutions have been spending a substantial amount of money in systems, in reporting, in human efforts, but unfortunately in many cases this is just serving the purposes of risk control, but risk control is necessarily risk management. So that was it's a personal opinion but based on some experience.
Does anyone agrees with it?
Well, yeah, I think that what Hugues is describing is obviously a negative aspect of what is happening. However, I would not be as negative overall. I do think that there are, first of all, in the first line of defense, in the management context, every manager in general should be very much aware of managing risk. Then I think that in the second line of defense, you see a lot of financial risk management which is occurring and which is working well, so it's not talked about. However, all the matters which go wrong, they are largely being talked about. And in this context, probably what has been had slightly or quite a negative effect was that through the Basle II context, there was put a lot of emphasis on capturing risk in models which then had a tendency to become stalemate almost and believed in without being questioned. And as a result, then there was a belief in if you apply this number to your capital, so you're on the safe side. So this is the negative part of it, but I would not throw all in the basket of negative effects.
Okay. Okay.
Just to maybe, we are insurers here, most of us around the table. No? I'll try to speak a bit louder.
Switch it.
Desperately seeking for the
Switch
button.
it on, yeah. It's not that easy.
That's better?
I don't know.
That's no difference.
Could you only speak louder?
I'll try to speak louder. I think there is a lot of risk management going on in insurance. It's basically what we do every day, but it's not the things that get into the press, obviously, because our business is actually taking away risks, a lot of small risks of all of our customers. That is something that has been functioning quite well for ages, I would say. But I think the examples that we all are referring to is more to do with financial risks at the tails. Huh? Let's put it that way. It's there that there is an issue. But I would say that there is no risk management. It's what we do every day.
Okay. Other question. Can risk be measured?
Well, we need to measure exposure somehow. So it's clear that there are some categories of risk which are easier than others. And measurement is not only the whole thing. In insurance, we know that we can provision, we can guarantee, we can provide collateral, we can have CEC agreements to do margining. So there are many ways to try to avoid to put a pricing on the measure itself. The problem is that we have to use some models. Those models, of course, are supposed to simplify a little bit the environment to come up with a measure, because we need to put ingredients which are observable and objective. And so not everything is easy to find out, so we need to simplify the models to be applicable. And of course, the more we go to more complex categories of risk, the more we touch to the limits of the capacity of using measures. Now you have market risks, we have credit risk, you have liquidity risk, and the more you go deeper and deeper to model risk, for example, or catastrophe risk, the more you go to risk which are, I would say, for a financial perspective, I'm always quite more talking about the financial perspective, but it's more difficult to put a value in it. That's why the big difference between tradable risk and insurance risk is that in insurance risk you can, I would say, work with tables of probabilities for some specific events, while on the financial side we always try to find a secondary market to be able to exchange the risks, and therefore that becomes more touchy, because there's a big difference between just having a probability to assess the probability of an event and trying to input that into a price of an asset which will be used as a transfer price of risk between institutions. So it depends on the usage of the measure itself.
What do you think? Can risk be measured?
I think you can measure a lot of things, but I brought an example, and I hope it can be shown here. There's a little exercise we have done, and we have now brought it until the end of 2012, and you cannot see the second line, but okay. What have we done? We have taken an insurance company, 1 billion euros in assets, and you see at the beginning it has liabilities only of 940, so there is available financial resources, there's 60 in it. And then the only thing that this company does, it doesn't do anything, it invests half in assets called Belgian OLOs for 5 years. That's the only thing it does really. It doesn't change anything to its to what it does. And then you see where do the 60 available financial resources. Now I should have said, because you have a Solvency II ratio that is on a scale at the right hand side. This 60, it only needs 40, so it has 150% of its solvency ratio. What happens? We go further, and when we are at the end of November, we are here at the end of November 2011, the Belgian government is still not there. We see that our company that doesn't do anything, that was well capitalized at 150% in 2 months, has lost all of its capital. There is a kind of red line. These people have to hand in, the management have to hand in the keys to the regulator. Finished. What happens to the same company when it just stays doing the same thing? And when we are at the end of 2012, this company has more than 200% of its solvency capital ratio. It has done nothing. Well, this is the standard Solvency II measurement. There are a lot of Belgian companies investing 30–40% in Belgian euros. This would be reality in Solvency II for them if they take the standard measurement. Can you measure it? Yes. What do you do with that? That is the question. You can think a lot about this. Do I have to introduce more capital? Well, you would have to introduce only for this, for the Belgian risk you have taken, because it's only the spread movement. You would have to more than double your capital because you are in Belgium. Well, imagine being in Italy. It's far worse than this. But there are other questions. Does a market value at one point in time tell you something about a portfolio that you have for 10 years? And how much does it say? Maybe quite a lot, because, well, if it would have been Greek bonds, you would not only have 0, but far less than 0 at this moment. So, and what is a market price? Is it a risk measure somewhere? No, it's not a risk measure. It's just, well, what the market is doing, because, well, it is afraid of something, or because of a lot of traders do something, everyone does the same because they want to get out. It doesn't measure for that a lot. But we use these concepts like market risk, rating agencies and their ratings, far too easy as a kind of, well, self-evident thing and a measure that you can just use. Because what did, in reality, can someone tell me what did most of the Belgian companies that were confronted with that do at the end of November 2011?
It can even be worse, because as Baloise Insurance we are under the regulation also of the FINMA in Switzerland. And if you would make such a curve under SST, that is the Swiss Solvency test, it would be even worse. But you're right, the 25th of November 2011 for every life insurance company in especially in Belgium was a dramatic day, and a week later it was already better. But that was the reason, what you said. A lot of our bond portfolio is in Belgium, and of course our liabilities are in Belgium too. So in fact that sounds normal, but Belgium was at the end of November 2011, it was the next PIGS country. Everybody thought, and at least our Swiss shareholders thought it too.
Yes, but is it
was a new PIGS country. But I think you can measure it, but I think it must put you to thinking what we have to do, because it's real, it's the markets, and what the consequences of this were that Belgian life insurance companies were concentrating their bond portfolio in Belgian bonds, not improving this picture, but merely from looking at your own backyard. Well, our liabilities are in Belgium. Let's put our investments also in Belgium, which is not market consistent. But it must set you to thinking what to do about it in the future, because it implies that there is quite a risk in your portfolio. And that's, I think, the advantage of models like this. But given the fact with our liabilities, and you said it, with 30 to 40% on a 4.75, the classical guarantee in Belgian life insurance, and giving an interest rate which can fluctuate over a week, there's a problem, and you have to manage that. And indeed, if we were already regulated by Solvency II, and the 25th of November 2011 was the moment you had to report, well, then we would all be bankrupt. But nothing happens, it's only in the future models.
Okay. Well, yes, but if that is what you are regulated like, what did people do at that moment? Everyone was buying Olos, huh?
Any reactions?
Yeah, reaction. First of all, I think it's a very interesting graph. It shows a very interesting aspect, but I think it is somehow an unrealistic approach. You don't have just Belgian Olos in your investment portfolio. Otherwise, you have not done any diversification also in the portfolio. I don't think that it also captures any impact of how the liability side of the company is moving. But it's good for purposes of discussion.
For purposes of discussion, but if you take a typical Belgian life insurer, you would typically not 50%, but see 30, 40%, and more than 90% in fixed income, but 30, 40% in Belgium, if it's Olos or anything else, well, the measurement, the spread movement would be the same. So it's quite realistic. Of course, it's a model. It reduces reality, but it is an aspect, I think, where we need to find a way to cope with it.
No, that's fully understood. But I think what I find interesting to see is you calculate it under a VAR model, Solvency II. I have seen a lot of these developments being calculated under a tail VAR, an expected shortfall measurement. And in this regard, what you saw is trends which are exacerbated over time. But these quick fluctuations from relatively well positive to very negative to, again, even more positive, that is something which, to my experience, doesn't occur so much with the tail VAR measurement. That's one point. And the other point is this shows that on the one side you have a model, but on the other side you also have a judgment process on what you do with the outcome of the model. And secondly, you have to have enough leeway in the definition of measures which you have to apply from now in the regulatory context, so that there is enough flexibility to cater for situations which may be a short-term situation, or where you clearly have the underlying analysis that the business has built-in flaw, which you cannot with more time also resolve. So I think there is a judgment which is needed there, which, however, needs to be backed up with a relatively flexible catalogue on the measures to be taken. That's my...
Okay. On measurement, this is a famous graph. I think all the big Belgian insurers made the same graph, and actually we shared that with the regulator in a very transparent way, and we said, well, there is something strange going on. It doesn't measure everything that should be measured. That was one of the remarks we had. Coming back to why it seems that there are so much Belgian bonds in these portfolios. Bear in mind that it actually there's a risk management argument behind that. Because a lot of our insurance contracts have what we call market value adjustments, where the surrender values are actually linked to the value of these bonds. So if the customers at that point in time in the valley would have come and lapsed all their policies, would have passed on this risk to the policyholder. So that was not really reflected in the models. And then what you're also referring to, this is a one-year VAR model, basically, Solvency II, inspired by the banks, but it's not really very suitable for a long-term business. And that is, I mean, it could be solved, the measurement of those elements. But today we are faced with this approach.
Okay, thank you. Another point Mr. Jorion said, Solvency II relies entirely on the major rating agencies. Isn't that a problem as well?
I would complete what my colleagues were saying, that nothing prevents you from having your own assessment. So what I could be blaming is the fact that in some cases we have been pushing too much for, or incentivizing people too much to just take the rating agencies. But we had them for a long time. So why is that suddenly this last year we start talking about them a lot? They have always been there. But we have to have a regulation that encourages also, like in the more principle-based regulations, to encourage still, even though there are some flows, we have to tackle the flows, but we still have to encourage banks and insurances to at least keep that competence inside to being able to build their own assessment. I think that's quite important. So, because risk management is not just, you know, in some big corporations or banks, we have a risk management function. And I think that is not just having one person responsible, CRO. Risk management is a kind of philosophy that should be part of all your decisions, like Antonio was saying, is part of your day-to-day activity. Everything that you do should be balancing risk and returns, and that's what I think.
Okay. Yeah, but we can't do, as an insurance company, you can't do better risk rating than the rating agencies. It's the best we have. And maybe they will become a better institution in the next years, but now it's what we have.
I personally don't fully agree with that, because they use ingredients, you know, you type Moody's and Standard & Poor's errors, and you will find thousands of links. So, because at the end of the day, they don't have more competencies than us, and they use exactly the same kind of data. So maybe for non-listed companies, yes, they have a pool of people that gather data for non-listed companies, but for listed companies, the scoring models are known. We know how to assess. Nobody tells us that one is better than the other. There have been major flaws in some of their models. And on top of that, in some cases, a lot of people don't make the difference between the point-in-time models and the through-the-cycle model. And if you're an insurance company, you have a long-term view on your capacity to, I would say, honor the rents. The point-in-time of the cycle now has no. So we have to be able to have our own assessment, because the rating agencies might produce measures which are not necessarily suitable to our time frame, I would say.
Another point, Paul Jorion said that research has discovered that there was no backlisting in the methodology of Solvency II. Is that a problem?
Well, I have a little bit of sort of a reservation in this regard, because if you look at how the process of Solvency II was managed, it had at least 5 QISs, which were very big exercises, and it's still not concluded on what the final terms are. Now, backtesting has also been done in a number of the company contexts. So I'm not so sure. Maybe there could be done more. That's always the case. But whether there hasn't been any backtesting, I would be hesitant to say that. All these processes have had features of backtesting.
Everybody agree with it?
Well, I think the main problem of Solvency II and also of Swiss Solvency test is yes, it is a moment, but also if the result is bad, you have to improve it in, well, let's say overnight. And I think that if you look at life insurance companies, if there is a problem, and looking at the graph, we still see there is a problem, you can't solve that overnight, because it's the results of 20 or 30 years of selling policies with little redemption costs and guarantees of 4.75 without calculating those components in the tariffs. And what we already said, a lot of our provisions are still on that guarantee level. You can't solve that. If Belgian interest rates or European interest rates stay at 2 or 3 or 3.5%, you can't cope with a guarantee of 4.75, and we still have it in our books, so that will take years. So I think the models, new regulation, very good, because it puts us on action to think about it, what to do about it. But you need years to solve it, or you have to create something like a bad bank, a bad insurance company. But I don't think that's what we want to do.
So what's your solution then, to give insurance companies more time?
Well, it has to be somewhat. Yeah, you need more time, but of course it can't be totally vrijblijvend. What's the English word for vrijblijvend? There's
Carefree.
a lot of restrictions on it, but you need more time. It's the fact of the business.
Yes, I do agree with that. Well, in this model, it's only spread. This is a perfectly matched, and there's so that effect is not in here. But I do agree when you look at, for instance, Dutch pension funds, if they don't, well, if they run into problems, it's a very long-term business. They can hand in a 5-year plan to cope with that, and they need to live up to that. You could, in these cases, but I really think you should measure. You should. I do agree with that. But if you take a measure of one point in time against 50 years of liabilities, I really think you need to give people some space to live up to what they have promised in a period far, far away from here.
I think that regulation in general does not require to address the situation just overnight. So, for example, in the Swiss context, those plans, they can have a time span until 3 years. And we all know that if there is recovery, there is a possibility also to expand that. And if I have, I don't recall exactly the timelines in Solvency II, but I believe they have been tighter at the beginning, but I think there is a realization also that you need time. Now, this is not the only measure you can take. So, for example, in advance to the introduction of the Swiss solvency test becoming fully binding in 2011 in Switzerland, obviously there were a number of groups who had particularly life insurance companies who were also not in a comfortable situation, but not in a really, really bad one. I want to stress that, not to be misunderstood. And what you saw nevertheless happening is, for example, reallocation of capital within groups, which sometimes is held at central non-life company, which is scarcely distributed to life insurance companies. So clearly this is something which can only happen in a group context or parental guarantees or similar capital surrogates. But you also obviously have a mechanism which is to cope with the heavy obligations from the past, but at least immediately adapt what you write in the present so that you over time have a managing out. So I realize that this is not an easy task and a very, very heavy burden, but on the other hand, I don't think that the expectation is to cure that overnight, nor is the expectation that it doesn't need multitude of measures which are being pursued and followed through over time.
Okay, some reaction?
Yes, well, what I also think is you need clear rules, and then be aware they will be too simple always, and then be aware that they are not 100% right all of the time. But you need clear rules. I think if everyone, I have a little, well, everyone can make its own models. We all like that, of course, but everyone is measuring different things. I am quite, well, what I would like is to have one standard measure where everyone has to do exactly the same. And then you can say, but in my own assessment, I do think that it is different. But now you can already use a model, and then you have to make an assessment, so your model is not comparable to anyone else, and I don't think that is right. That's my personal opinion.
Some reaction?
I think that's correct. And well, as a matter of fact, with all the models, all the regulations, the more reporting you have to do, the more your own judgments, your own model points, your own curves, it's less comparable than maybe 20 years ago. And of course, uniformity is good, but that's a very difficult subject. And if you look in Belgium to the flashing light reserves, the FAS, which has to be presented to the regulator. Every insurance company does it in its own way. That's an indication. It's not so easy to make uniform, strict regulation on models and assumptions.
Mr. Cano?
Yeah, I think we have a very simple model already. It's called Solvency I.
Simple.
Yeah. So, and that's exactly my point. In Solvency II, you will have the standard approach, which I believe you will have to do anyway. So that will be something comparable. It's less problematic than Solvency I, but I'm personally a strong believer of an internal model. Particularly because it's going to be very difficult to have a Solvency II model that really captures all the peculiarities of portfolios, businesses. I think you need the two. But yeah, as everybody says, there are big limitations on models. I'll sometimes say I like models a lot, particularly when they're blonde. Sorry for the...
Yeah, maybe about Solvency I, because that's indeed not so difficult. We know that our life company has some troubles related to that growth. But our Solvency I ratio at the end of 2012 has never been higher than it was. So that looked very spectacular, but everybody knew that, well, we had some problems. So.
Well, I would say that it's all gets down to liquidity and how far you want insurance companies to be liquid or not. Because you have a confrontation between the cash flow stream you need to honor and the fact that for pricing reasons, all these measures are discounting everything to today's prices, with the curves we have today. And if the curves gets crazy because the behavior in the market and the risk aversion of individuals starts to be a bit irrational, let's say, well, it could be irrational, it depends. Again, what is your timeline? If you run to the bank to withdraw your money because you have a time horizon which is of 1 week, it's rational. It's irrational to run to the bank if your time horizon is maybe 10 years. So typically, we need to make that assessment to say what kind of liquidity risk do we want to let in the system and how much of that liquidity risk should be managed by the institution. And I think that sometimes we don't have this helicopter view to say where are we really putting the knife? Where is the liquidity risk that the state, the government, the community wants to take, and what is the liquidity risk which is supposed to be borne by institutions. And once we have made that judgment, then we know if a measure can be good or not.
Okay. Mr. Janssen, you also said that, you're also saying that not anymore the investment income will be the driver of your profitability, but more and more your profits must be more operational, isn't it?
That's right. If, well, in history, we said to each other that we were very good insurance managers when we reported record profits. But in fact, the record profits came from the investment income. And when we had an equity year of 20 or 30%, or when the interest was higher than what we guaranteed on our liability, I think that's over. I think in the, and I don't know whether it's 5 or 10 or 20 years, but I think huge investment incomes, which were mainly coming from a mismatch from your assets and your liabilities. And with the new regulation models, mismatch is punished in all kinds of scenarios. So there won't be a lot of mismatch in the future products, in the assets and the liabilities. So probably there won't be a lot of profit on investment income. So you have to do it on your operations and to strive for operational excellence, cost cutting, which is already happening, of course, in the sector. And I think there you will have your profitability. This is life, but if you look at non-life, then most groups, they will lower their target combined ratio. And they had 97 or 95, they're going down because that's where the future profit will come from. And maybe that gives a pressure on the premium. The premium is increasing, but you will have to make your operations more profitable too, more efficient. That's our opinion on it.
Mm-hmm. Do you see the same at AG Insurance and Belfius Insurance?
It clearly is so that the last 5 years have learned us that investment income is not really, well, you shouldn't go to the margin of that. And we clearly, but I think all of us have a policy that already your technical operations must be very profitable as such.
No, I think it's true for all the insurance companies in Europe. Having said that, we should then not go overboard and saying we don't want any investment activity anymore. We just want to ensure longevity or death. I think there is a big demand in the market with customers for long-term savings, and we provide that. And we should strive to have some sort of investment margin there, because we give certain guarantees, we run certain risks, you need a certain margin. It is increasingly difficult, but we should not, I think, as a sector, run away from that. We should have a bit of a longer-term view, and maybe interest rates will go up again, or customers will be accustomed to having guarantees of, say, 1%. So I think it's dangerous to say, oh, we don't want to be in this long-term savings business anymore, because that's our view.
I agree with that. The easiest thing is to say, well, pension needs of people, the insurance sector doesn't care about that anymore. I think that is a very, very wrong way to go.
Yeah. Okay.
Because there is a real need, and we need to respond to that.
Some last remarks about Solvency II?
I am happy to offer some. Because we in Switzerland have also introduced such an economic solvency assessment, and we have had it based on a law which came into force in 2006, and there was a transition period for the companies to get into the models of applying it until the 1st of January of 2011. And the interesting lesson and experience to be learned from that is, before it came into force, there was also full force in 2011, there was also an attempt to postpone it, because clearly it put some stress on certain players which would have wished to see more of a transition period. However, this was kept, the deadline was not removed, and with the possibility now to look back, many companies have acknowledged in a study which was done by Ernst & Young that they have been able to capture quite a lot of benefits from a much more granular assessment of risks and much more risk management driven approach to doing business. As a result of that, there are still questions on what is the right level and what is the wrong level and how do you cope with certain details. But nevertheless, the methodology compared to what was the Solvency I methodology has been perceived, at the surprise of many of those who watched this market, has been relatively positive in the big picture, with always reserving the discussions on details. So maybe that is an encouragement to also take these fruits on board.
Okay, thank you. Let's talk then about corporate governance. Since the crisis, there's more focus on corporate governance. Management need to be fit and proper. My question is this a good instrument to introduce ethical principles in financial institutions?
Is fit and proper already ethical? What is ethical? It's a very difficult term. Fit and proper test exists since a lot of years, and so it's not really new. What we see now is that you have a lot more detailed regulations, that you have far more paperwork to do. To a certain extent I can understand that, but there's an overload of administrative work linked to that, I think. We have loads of people writing all kinds of policies on how to make policies, and there's an overload.
Do you see the same?
Yeah. The governance workload is quite impressive, and that's an understatement. But I think the fit and proper principle, and I was strange that we should introduce it. I think I should have never. Ultimately, that is really for me the key, because you will always find flaws in models, and people are very smart and can misuse models. At the end of the day, you need people running banks and insurance companies with certain ethical standards, and you can discuss what that exactly is. But I think we all agree on what it is not, so that's already quite a step. And I think this chair is all about that. Ultimately, that is for me the best risk management philosophy, to not let financial institutions go bankrupt. But I appreciate that the regulator, the supervisor, they are the ultimate ones to test the fit and proper rule, and that's not evident. It is not doing an exam.
I think that if it's about making sure people that are running institutions or even small ones, because I'm not sure that the regulation is about the size of the institution. I'm not sure the size should be a problem. If you run an institution, you run an institution, whatever the size is. But if it's about ethical standards, making sure you have people with no bad track record, I think this is, at least it has the interesting, it's interesting to bring this on the table and to see how we can put some standards about it. If it's about competences, then it starts to be more difficult, because it's not because you are a super quant that you have a good overview of what could be the triggers. And so defining competences about making sure in the future we reduce exposures of firms is something much more touchy, and I think that it would be hard to find somebody really independent to judge that.
Yeah, I think it's all you mentioned is right, and we do write a lot of policies, and sometimes you wonder whether it's necessary that we do write it so extensively as we do. But I think it's, and indeed, given all the policies, that doesn't mean that everybody is acting in the correct way. I think you also need a good balance between people in management and between management board and supervisory board, for example. If you have a management board who is too strong compared to the supervisory board, that's not good. If it's the other way around, it's not good. You must have all the disciplines in both boards, and you can do that with regulation too, of course, with external people in supervisory boards. But you also need, and then it comes to the people, a good balance, a good knowledge in all committees. And I think that's also a guarantee that nothing strange will happen.
Some reaction, maybe?
Yeah, I think that it is very important not only to look at, say, the technical competencies of doing the business, but also at the judgmental part of it, the qualitative part, if you want to call it like that. There are a number of problems related to it. I think one has made in many jurisdictions considerable progress in approaching the topics, but there is a risk that with approaching the topics, nevertheless the overall view is being lost, and there is a risk of getting lost somewhere in the forest with a lot of details and bureaucracy. And so how many times did the committee meet, and did they get the files in advance and things like that. So it has a bureaucratic risk here, which I think is very detrimental. But overall, I think that the qualitative assessment of, and the qualitative part of approaching the business is absolutely key. It cannot be done with it. But I think that's something which was known long before there was a big discussion around corporate governance.
Okay. I have an additional comment. This is about individually assessing people, but we have seen many situations where it was the corporate environment which was bringing a misuse of something or a habit which was not perfect, but that the community thought it was correct to do. And we have seen it in many cases in many banks, with the John Kerviel case, with the people using the access cards, etc. But you have some behavior with, at some point, become quite normal in the community. So it's not just about individuals. Sometimes they're not reinforced alone. The environment starts reinforcing some behaviors which provide some flows, and this is not necessarily seen as criminal by people really with the head in the mud at that time.
Okay. What are the risks for insurance companies due to the complexity of group structures?
I think we all work at groups.
I am in a very simple group now, but I don't have any lesson for anyone about big groups coming from the Dixian group.
For example, Baloise is a big group.
Well, what I said in November 2011, our mother company thought that Belgium would be the next biggest country, but nevertheless, they invested money in Belgium to buy 2 extra insurance companies. So then you see that, and I don't know whether that's the risk of a group, but that's a strange phenomenon. That on the one side you invest in the country because you think, well, insurance companies are good and profitable there. And on the other side, you think from an asset management side point of view, well, the country is maybe the next biggest country. But in groups, but that's not the case within our group. Historically, you had a lot of financial relations and some, but I think that's over now with the new group reporting, but you had double counting in the holdings on top, where, for example, the holding could be very solvable, with a lot of solvency, and all group companies were below the required solvency level, and that's of course quite strange. But I think that's over now. So.
Yeah, it adds to complexity, and indeed what we call the diversification benefits within a group, which was one of the reasons behind a lot of bank insurance models of the past, that we have seen that was a bit, that they did not exist in the end. And I think that's a sound principle that within a group, and a group can add value, but within a group, each operating company should be looked at by regulators as they do supervisors on its own merit, and not look at aggregate solvency levels and so forth, which is very tricky, particularly when markets are really in difficulties. Then you see that those diversification benefits, they do not exist. But yeah, it's fair to say that it doesn't make matters easier.
Yeah, and of course, if your holding is insurance company too, you have the advantage that you are in different countries, but of course the disadvantage that you only have insurance companies. For example, the first financial crisis in 2008, then banks and insurance companies realized that they were all invested in each other. So, if your market price went down, the guys in which you were invested, their market prices went down, and it was, well, some kind of bubble, which really gave some trouble, that we were all invested in each other. So that was a problem at that time.
Okay. Some other reactions?
Well, I think that the diversification benefit should in general not be underestimated. So with a group operating in a number of jurisdictions, you get diversification, geographic diversification, you get business diversification, you may have, particularly if you have a lot of investments in local markets, you may have diversification also in investments. So I think first of all, these benefits needs to be taken for their value. However, where I see more of a challenge is the management of the complex structures which result from that. And this is not so much maybe the perspectives which are very complex, the perspectives from the subsidiary point of view, but certainly from the group management point of view, it is complex. But remember that even the large insurance groups in the systemic risk analysis have been compared to the bank's structures. And the number of subsidiaries which are in these largest systemic risk banks is in the thousands, in the several thousands of companies, where even the complex insurance groups, the large complex insurance groups, they may have 1,000 or 2,000 subsidiaries, and the large banks, they have 6, 7, whatever thousand of subsidiaries. So these are very complex structures to manage. Then, yeah.
Okay, thank you. You
Just perhaps some word on the diversification. Normally, the arguments are the other way around. It's the groups claiming to have a lot of diversification benefits. They are there in non-life geography, but I think one of the lessons of the crisis was, for me at least, that really in stressed moments, at the tail, diversification disappears. I always say correlation jumps to 1. And it's there where you actually need all that capital and where your diversification benefits. And that's more on the financial risk side, huh? Not so on the non-life or geography, but in the market risk side, it's gone.
Yeah, I think in the insurance risk it stays
stays
more than in the financial risk area. Yeah.
Okay, thank you. I would like to return to the topic of risk management. Jorion answered the question. Next question: if something cannot be measured, should it be forbidden? And he was interested in your opinion about it. What's your opinion?
Well, can you measure love? That's no reason to forbidden it. But I think in essence everything is measurable. But of course, if you have a list of 30 risks with all the amounts next to it, well, you can argue every result. But the relevance is also in the comparison from one moment in time to the other moment in time. And you can have long discussions about the risk of, let's say, 30 million. And that's right, maybe it isn't 30, but it has to be 100 or 10. When it goes from 40 to 30 with a uniform model, with a uniform calculation, then it says something. So it's not only the height of the amounts.
Yeah, in governance, negative pledges are never the best solution, because if you start prohibiting, at least on the financial side, there are plenty of ways to circumvent or bypass the prohibitions. So in the 80s, when we had the Brady Commission about after the crisis of '87, there were a lot of debates on the question like, should we prohibit derivatives? And everybody was showing that, in fact, you could prohibit them, but for big institutions, they could replicate them the next day. So prohibiting is maybe one thing, but it's not by far the best solution. But trying to find positive incentive is always better, to have people working in the aligning incentive in the right direction. Typically, for example, when, of course it has to be debated, but typically out of the blue, if you had these shops, these banks selling structured products, you could say, oh, we don't want them to sell this kind of structured products. Well, if you start building a typology, names can be changed, reformatted, and you can come up with a new structured product the next day that has a different name. Now, if you would have said, okay, you can sell structured products, anyone, any structured product in any shop, but there are two conditions to that. First of all, you need people that are able, at the location where you sell it, to reprice it and give a price to the person in the ticket in front of the reception. You have to be able to give a price almost instantaneously about how much is the liquidation price back to the bank of the product. And on top of that, you have to be able to take it back at any point in time, not by calling the name of the bank, financial services, in that kind of jurisdiction, but here, directly at the shop. Then maybe you would have had a reaction where banks would have said, okay, we have main locations where we sell them, where we have the competence, but we don't sell them everywhere. So this is more a way to say, okay, you can do whatever you want, but we ask you to have a good behavior about it, and to try to foster good behavior rather than trying to prohibit things through a name which can be changed, reformatted, or whatsoever.
What do you think?
Well, the question was if you can measure it, but well, we will all drive home tonight, well, some by car. There will be fools on the road, some people drunk, a few will have no lights on, here in Brussels especially. Toyota might have to recall one or another car. They have done so in the past because things are not all right. But most of us will get home. I think in the end there is little freedom of enterprise. This is our society. That's how we progress. And of course, we should forbid to drive with some cars, etc. But in the end, we need to preserve the principle that we can be enterprise, that we can do things, and that we can take initiatives, and that we are not limited to doing exactly what has been done in 1100s.
I would concur with what you say, but probably the matters which are more frightening are those where people fly completely blind. They have no lights, they have no brakes, they have no understanding. So this is where the real hard cases are. And this is where I would suggest to consider to phrase it a little bit differently, namely not to forbid an activity, but to require that when you undertake an activity, that you have a reasonable level of understanding of that activity. So you never can know everything about something, and you have to have certain risks. But I would suspicion that many of the managers who sold some of the, even of the CDOs, would not have been capable to describe the content of the CDO in 5 sentences.
That is true. Yeah, no, it's perfectly right. On top of that, we have to think that what we are talking about is finding the right level of risk requirements. We want to understand when do we estimate that it's normal that the community bears the risk. So we don't want the community to bear all the risks. So we say, okay, the institution should take a burden on their own shoulders, but at some point we have to be careful about not going for regulation that would say we want no risk at all. I lived in Latin America for many years, so shit always happened there. But I'm afraid that sometimes we are trying to go to the other extreme, which is shit can never happen. So we have to be careful about that as well. We have to find a good point to say we want to avoid moral hazard, we want to avoid bad behavior, willingness to take risk on the shoulders of somebody else, that's true. But at some point, the business, traditional banks, traditional insurance are pursuing a societal function. And this cannot be, of course, prevented by willing to take no risk at all.
No. You could rephrase the question, is it allowed to take risks that you cannot measure? And then the debate is what is measuring? Because you could say, you first identify which types of risks, what type of shit can happen. Then assigning some sort of probabilities to it, and that is where it gets very messy, because there are a lot of risks, particularly again on the tail, that you don't know what the probability is going to be. But sometimes you have a feeling, or you can calculate, if it really goes wrong, what's my maximum loss? How bad can it get? And then you should consider, okay, am I still alive if that happens as a company? And then you could say, yeah, I can take those risks. I do not know how to model them exactly, but if it happens, okay, I'm still alive. I'm a big fan, more like stress scenarios type of approach, which is a bit that.
Okay, thank you. Are there some questions?
When we talk about prohibition, there's a difference, I would say, between different types of prohibition. If you say, well, there's a product which is very dangerous, which is I mentioned CDO square, and say, okay, there's a new law saying you can't do CDO square, and then somebody will make up, as you said, you will make a new combination of options and you would do it otherwise and you would be long on that position and you would reproduce something that would have a different name and it would be, but would actually be the same thing. Okay? You can make a fake sale that you call a synthetic loan. We all know that. But when we talk of prohibitions, we may be talking about principles. The difficulty we have when we look at the Frank Dodd Act, it's something like 800 pages. And when I see that, I think these people have not thought about the issues. They've been taking existing rules and they've been modifying them. They say, well, this you cannot do this way, and you replace 25% somewhere by 30%. But they haven't thought about what went wrong with the crisis. Because if they had, they would have some very simple principle that they could act, and it would take maybe 5 pages to tell you exactly what you should need to do and what you should not. I'll take just one example. I don't remember the exact figure, whether it's 7 times or 16, but you will see it doesn't make much a difference. Currently on the future markets for gold, every day of the year, you're trading something like 7 times or 16 times the existing capacity of having gold on the planet Earth, right? This is shifting the prices for gold. But it's the same if it were grain, if it were cotton, if it were cocoa, and we've seen it in 2008. You can try to, and these future prices, they become the spot prices. Somebody has told me once in a meeting where it was university professors, but the 2 models for spot and for future are totally different, so there's no way they can communicate. And I said, I've been in a trading room where the guy for the spot was there, the guy for the future, and the guy for the spot said to the guy for the future, what's the price for tomorrow? And he wanted to give the one for the future, said, that's what and that's the way it works. The guy was in university, he had no idea that these people communicate. I saw they were sitting there next to each other. So my question is the following. Prohibition can be prohibiting anything at the lowest possible level, or thinking of what went really wrong. When we say, when we move from a position about systemic risk, systemic financial institutions, and we say, all of us, we all say, everybody says, in 2009, there's only one approach to that, which is dismantling them. And then we've moved over the years, without even realizing, to say, should it be 1.5% additional reserve or 2.5? Hasn't anything gone wrong in the process?
You want to react?
Yeah, well, the 2.5 or 1.5 or so, this is not making the big thing. The big thing is the reduction of risky business, which in terms of bank balance sheet has an effect on the amount of risk-weighted assets which they hold. Now, we all know that there are also differences in calculating these risk-weighted assets, but nevertheless, we have seen over the past year, we have seen considerable impact there. And what we also have seen in the banking business is that some of the banks have made considerable changes to their strategies. So some have decided to reduce considerably their investment banking strategies or activities. Others have decided maybe to reduce their retail, etc. activities. So is the 1.5 or 2 or 2.5 really making it? I don't think so. But if you have a wider assessment, maybe it's not that nothing has happened. Is it enough? Well, this is hard to predict, and nobody has crystal balls, but the past experience tells us that there is always something which is unforeseen, which may materialize in the future. Hopefully not the same we have had already.
I think it's a bit of a banking problem or financial market type of problem. I also hear about shadow banks, and sometimes insurers are called shadow banks. So you could try to reduce the leverage of banks, because a lot of the problem is the leverage, but you can also create that leverage through derivatives. So I don't know, I'm not a banking specialist, but it doesn't look easy. And the liquidity, the massive liquidity in the world moves to find a yield, and if leverage helps to get more yield, I mean, I guess it's always been like that. So I'm not so sure whether we can avoid that. We could, as a society, try to avoid that. That does not have big impact on the real economy.
I would just say one word about deleveraging and de-risking. There is some confusion in the sense that the risk is because of two reasons: because of a huge leverage of banks, but of course also because of the activity risk. And when we talk about de-risking, it should be about the fact that we want to deleverage, but we don't want necessarily to take them less activity risk. So, of course, they have a high level of required cost of equity because they have been leveraging a lot. So, the easiest way to increase your ROE when you have a very small amount of equity is to have even a lower amount of equity. That's much easier than anything you could do on the asset side of the company. And that's all.
Other questions?
About bank insurance, how come, did it really fail? And second, why did it fail? I mean, I remember 15 years ago, there was the name of the game. And we had Fortis, we had Paulus merging with Citibank, we had Alliance buying Dresdner in Germany. And did it really fail? And second, why did it fail? Why? Because it makes so much sense. Banks can sell insurance products. Insurance companies can sell banking products. It looks like a no-brainer. Why did it not work properly?
I've always worked in a bank insurance environment since I started working in various entities. It has not failed. It has not failed. As you're saying, banks can very efficiently sell insurance. They still do. They have about 80% of the market in Belgium. Across Europe, it's 50 to 60%. What has failed is this diversification idea that you had, that you put a bank and an insurance company together. The bank has short-term deposits, insurance has long-term liabilities, so we put it all together, we have a match position. That idea has failed. But the business idea of a bank selling insurance, it's happening all around the world. In Asia, it's taking over the market, so the business idea has not failed. That's my very strong view.
I'm quite close to that in distribution. We have a lot of distribution by the bank of insurance products as well in non-life as in life. There's no problem at all out there. The only thing is you need to respect and to stay other companies, because it's a different. I have been a long time in banking. I am now for a long time already also in insurance. I'm just old. Well, it is a different ball game, and you need to keep it differently but the distribution side of it, I see all of the big here in Belgium, but everywhere in the world, in fact, that it works.
Yeah, I agree on that. I think the balance sheets, you have to keep it separated. That's indeed a different kind. But as far as distribution, if you look at 2012, I think it was in the paper today, in branch 23, I think there was in 2012 an increase of the turnover in life in branch 23 of 136%, and that's mainly caused by selling those products through the bank channel. So that works.
You're talking keeping balance sheets separate. How can you do that? If it's a Citigroup has insurance and banking, so how can you? Citigroup has one balance sheet. How do you split that into?
Well, in the holding, you have to consolidate, but if you look at risk management and governance and models and asset liability management, keep it separately.
treasury.
And don't try to combine it. What was just said, what was looked at the big advantage of 50 years ago, that putting it all together would be great. And, well, it proved not to be great. But in a holding, you always have a consolidated balance sheet, of course. That's right.
Other question?
There is something that puzzles me. I heard mentioning that it must be true that the income from investments is shrinking, and your profit must now come from operational excellence and efficiency. And now I hear the other side that 80% of the market is over-the-counter selling of one-size-fits-all products by banks. So you must really be confronted with a very huge problem. Your investments, your income from investments vanishes. You need to compete between each other, but 80% of that market are over-the-counter products sold in bank offices. So it's really a problem that your business is confronted with. Or do I get that wrong?
If your pricing is good at the beginning and you keep your costs low, you can calculate your margin from the beginning, because in over-the-counter products it's easier to know where you end up. It's far more difficult in a product where you will pay a pension to a person that is now 40, and you pay a pension from 65 until that person dies. That is far more difficult than an over-the-counter product to
I
so
think you're right, but nobody said it was easy. But it also depends on the common sense in the sector. Because if products are really comparable, then it's very easy to make a tariff which is €10 cheaper than your competitor. And if the next one thinks the same, then you have the problem again. So common sense is really necessary.
but
I'm not so sure if all the banks do like over-the-counter type of hamburger type selling. I don't think it's fair towards most of the banks. I think there is still quite some advice being given, and regulation is demanding that. MiFID, banks are subject to MiFID and increasing rules, so they are not able to sell all types of products. So the more complex one they stay away from, which is a wise thing. But saying it's just over the counter, not really.
Okay, thank you. We've time for the last question. Maybe two short questions. Okay.
I have one question. I think Monica touched a little bit on the subject, the difference between pension funds and insurers. And now I read this morning in the paper that Belgium has joined a group which is against that the Solvency II is going to be applicable to pension funds. Which way you would like it to go as being insurers? Do you want the pension funds under Solvency II, or do you want to go more in the direction of what the regime that the pension funds are following, if that is not Solvency II for your life?
a few 100,000 people, I think for 1 million people in the Netherlands, might have an answer to that. They receive 5 to 15% less in pensions out of their pension fund today than they used to 2-3 months ago. So a pension fund, the risk is with a pension fund if the sponsor, which is the employer, is not prepared to put more money into it when it can't meet its its targets, it's finished. There's no capital. It's a completely different thing than an insurance. You can say, okay, put more capital into it, and I think there should be a bit more capital in it to make it a level playing field. On the other hand, I think, well, we see live examples of the real difference between the two solutions for pension.
Yeah, I think a lot of group life insurance companies, which is a big market in Belgium, would probably like something that resembles what the pension funds have. Some might. I would be inclined and looking at the protection of the affiliates of the pension funds, to have more Solvency II-like approaches, so therefore capital in the pension funds, because it is the same risk that you're covering. You are covering the long-term pensions of people, and there have been some accidents in the Netherlands. It's well known. There have been big blow-ups in the UK of pension funds. Or you should make it very clear that it's something very different, and that a pension fund, that you might get a pension, you might not get a pension. Huh? But that's not the perception of the customer. No.
Okay, thank you. Last question?
Yes, I wondered, I heard the comment of Mr. Cano that he said like there's a future for long-term savings, that he sees the future. And I always thought that there was no future anymore for this kind of product.
That no future.
Well, no future. I thought, why not leave it to the banks, this kind of products? Because, I mean, it consumes a lot of capital, and in the low interest rate environment, your margin on that is not that excellent. Let's say maybe you hope a bit on the cross-selling to make it profitable again. Or maybe you have some secret investment formula that nobody can share. But I just wondered, I mean, shouldn't insurance it has grown a lot in the past years. It was good times, everybody sells branch 21. Don't you think it's time that maybe you face reality and say, okay, these big balance sheets, that's maybe not what we want to do anymore. Maybe we should focus on the real insurance covers, more going to the mortgage loan insurance, do some more innovation there. Or, I mean, for me, I have different opinions, so I just wondered if you could elaborate.
I think you could say, okay, banks can do that. I think that in principle there is nothing that prohibits banks of offering long-term deposits. They don't, huh? But in principle they could. They're very uncomfortable with that type of business, because their balance sheet looks very different than an insurer. They are much more on the shorter term. They give mortgages, a lot of it's floating rate, etc. So it is an uncomfortable horizon for them. The typical joke for a banker, everything that's more than a week is long term. Okay, so but they don't. On the other side, I think traditionally insurers, life insurers, have provided pensions. In Belgium, it's a strange country because pensions are not real like annuity-like pensions. There is no mortality risk or longevity risk. We shy away from that, also because the customers don't want it. But that's the natural market of life insurance companies. It is, yes, in case you die along the way, you can have an extra capital for your children or whatever, but we provide something for you for your pension. And we tend to invest then long term, and we used to buy a lot of Belgian bonds, and we try to invest more like in infrastructure, equities, if Solvency II is not prohibitive. So that's much more the way that we look at the business, a longer horizon, and trying to have long-term guarantees, which are illiquid, and that's what we play with compared to the banks. The products we offer are not liquid, so therefore we can invest in non-liquid assets, and that liquidity premium gives us an edge. But banks could do that if they want. Huh? principle. As in the Netherlands, banks have entered big time the long-term savings market with bank products.
Okay.
So.
Thank you very much for your attention.